everybody. Thank you so much for joining us today. I am joined with a couple of special people here. A little bit of housekeeping before we jump in, but the topic of today is the ADU opportunity in maximizing returns in today's housing market. So a little bit of a different take on kind of what we normally talk about. We normally talk about trust deeds and buy and hold rental properties, and we're going to definitely talk about the latter for sure because ADUs play into that. But I think you're going to be intrigued by what you hear from the gentleman I have with me today and what they've been able to do with their company Butterfly, which is a great, just a really cool concept that's doing a lot of good for a lot of people. So I'm going to jump in for a few minutes here. Quick housekeeping, if you have questions, please do not wait to type them in the chat. People are still joining, so I'm going to kind of fill a little bit of time with some housekeeping here. Everybody will get a recording of this once it renders after we close everything out. Don't be shy with your questions, type them in the chat. I'll probably answer some along the way if they're simple questions I can answer, but bring on the questions for Mark and Xander here with Butterfly. Because we're gonna dedicate some time at the end of this to get in and answer your questions in detail. Okay, not just with a message. So as people are jumping in, let me introduce myself. I'm Brett Sininsky, and I am a self-directed IRA and solo 401k consultant here at Sense Financial. I am also a client of Sense Financial, as a matter of fact. I do have my own self-directed account. My contact info is there, and just a little disclaimer, we're not providing legal or tax or investment advice. Nobody on this call is. If you need such advice, then please seek out a competent professional in that area. And by the way, if you need one of us here is probably more than happy to provide a referral to a good tax advisor or attorney or whatever else. So quickly about us here at Sense Financial, we are a boutique financial firm that specializes in self-directed retirement accounts with checkbook control. Now, checkbook control, real quick, allows you to bypass or eliminate the custodian when you're investing. And that's really an efficient way to do it, especially when it comes to alternative assets like investing in trust deeds, private loans, real estate, of course, because if you have a rental property inside your 401k or IRA, there's bills that need to be paid. There's transactions that need to be done on a regular basis, and having to go through the custodian for all of that adds transaction fees. It adds red tape, time, and delays. We get a lot of referrals from people who offer syndications and multifamily and such, and they love the checkbook control aspect because it's just so much more efficient and quick at getting the money into the escrow or title company for the initial investment. So that's a little bit about checkbook control versus not. We've been in business since 2010, 15 years, a little over, so well past the startup phase. When Dmitry Fomichenko, the founder of this company, was getting started, he initially only specialized in self-directed IRAs because that's kind of how he began. And shortly after, Sense Financial started offering solo 401ks as well because it is really, truly a more robust type of plan if you are self-employed and you can qualify for the solo 401k. Our clients love us. We have 5-star reviews all over the place. You can check those out on your own. And I encourage you to, if you're shopping around for I'll call it a partner for lack of a better term, to provide a self-directed account for you, then I think you should check out the reviews and see what you're getting into before you go too far down the rabbit hole. We have assisted over 5,000 clients, established over 6,000 different types of self-directed retirement plans, and most of our clients come from referrals. Actually, probably over 90% of our clients come from referrals from different sources, but 90% of those referrals approximately come from our existing clients. And so I think that lends itself to the job that we do and the quality of work that we do. And our credit to the founder of our company, Dmitry, because he has said no to a lot of shiny objects over the years And we could have added on all sorts of stuff, but we have stuck to solo 401k and checkbook IRA only. And because of that, we do it at a very high level. It's at the end of the day, it's not rocket science, but every client situation is a little bit unique, and so we customize our approach and our guidance, of course, based on the client and their specific goals. So real quick, the benefits of the IRA and the 401k, I touched on this a little bit, but they do allow you to invest in alternative assets, which to me means true diversification, right? You can invest in the S&P 500 and be, spread out over the 500 strongest, wealthiest, whatever companies across the country. And are you diversified? Sure, to a certain extent. But I don't know about you. I don't control what Elon does with Tesla or, Zuckerberg does with Meta or any of those companies, right? So with checkbook control and with alternative assets, you can invest in what you know and what you understand. And for a lot of our clients, that's real estate. For some of them, it's crypto. For some of them, it's precious metals, private lending. In fact, the IRS only tells you what you can't invest in, not what you can invest in. You cannot invest in collectibles and life insurance in an IRA. And then there's S corporation stock, of course, because you have to be a human to be part of an S corp. But also, there's certain disqualified parties and prohibited transactions to be aware of, which is just invest at an arm's length with third parties, and you really don't have anything to worry about on that front. So the sky is pretty much the limit. And the plans can either be tax deferred traditional or Roth. And obviously Roth is the best in my opinion, because that's tax-free ATM withdrawals when you retire. And furthermore, and this will play right into the guest speakers today, if you are going to buy a rental property, let's just call it a single family home, and it's in a market and an area and a type of home that you would at some point love to live in or use personally as a vacation home or whatever. If you do that in your Roth account, 401k or IRA, when you turn 59 and a half, as long as you've had it for at least 5 years, you can distribute that house to yourself completely tax-free. You literally just do a distribution through the custodian, change title, and now you own the property. It's amazing. Now, of course, you're responsible for it at that point, all the fees and all the expenses and the holding costs and everything. But you kind of were before too. It was just your IRA or 401k that was covering the cost of all that stuff. So just plant a seed for your edification there. And then you can get financing, which is going to play directly into what we're going to talk about today, because not everybody has enough funds inside of their retirement account to build an ADU or value add, even if it's like another bedroom or an expansion of the kitchen or something like that, right? So you can get a non-recourse loan, which means you don't personally guarantee the loan. That would be a prohibited transaction. You can get a non-recourse loan. Your IRA or 401k rather can get a non-recourse loan, and you can pretty much borrow or double the amount of property you can purchase, or of course add on. Now it's a little harder to get a construction type loan with non-recourse financing, but it is doable. And we do have a list of lenders on our website that you can search through, SenseFinancial.com /non-recourse lenders, and you can see a list of different ones there. We talked about the checkbook control already, and the solo 401k, we call it the ultimate retirement plan. If you're over 50, you can contribute up to $77,500 for 2025. If your business, your self-employment is earning enough income, then that is the max that you can do. And by the way, that doubles for all business owners that are participating in the plan. Married couples, both spouses can actually both participate in the plan if they're getting employed by or getting compensation from that self-employment. So as a married couple, you can put in $150,000 of either traditional type contributions where you're deferring the tax, or Roth as well if you can take the tax hit right now. So really a great plan. I mentioned the unlimited investment options, so I'm not going to harp on this, but they really are almost truly unlimited. And Again, a point about investing in what you know, control, and understand. If you choose something like real estate, I'm just using that as an example, I'm not advocating for it necessarily. Um, when you invest in something that's secured by a hard asset like real estate, if there's an issue with the loan or with a tenant or whatever, there's still a hard asset there, right? You just don't have that type of control. Two people signing on the dotted line with what the returns are going to be, like a tenant paying a rent each month, or just if it's a trustee, a private loan, what the terms of the loan are there points, what's the percentage, is there a balloon, is there not, whatever it is, right? There's just so much more control. I'm not going to use the word guarantee, but when two people sign on the dotted line and something is secured by a hard asset like real estate that you can foreclose on if there's a default, then that's as pretty close to a guarantee of your principal being safe as you can possibly get, right? You just don't get that in the stock market. And I'm not bashing the stock market. I have money in the stock market. I think it's part of the diversification play. That's my personal take. I'm not giving financial advice, but there's just so much power to self-directing when you get into just what you have experience with. And I mentioned this, it does provide true diversification. Don't put all those eggs in one basket. Ecclesiastes 11:2 says, divide your portion to 7 or even 8, for you do not know what misfortune may occur on the earth. And we don't, we had 2008, of course, 2009, we had COVID, things shot up after both of those things. So there's ups and downs and everything in between. But if you were diversified in the way that I've been talking about, you were pretty steady during those times because the money was still coming in. The money was the income from the investments was most likely still coming in, as opposed to just being in the stock market and watching it go like this. And then of course it did go back up, but you just never know. So with that said, I'm going to introduce our guest speakers here. Mark Rappaport is the founder and CEO of Butterfly, a company that designs and builds small form factor housing to address Southern California's housing shortage. With over 25 years of experience in real estate development, acquisitions, and finance, Mark has built a deep understanding of residential and commercial real estate. His development track record spans award-winning housing developments for the middle market to luxury custom homes in Orange County, and his expertise extends beyond traditional development through early-stage investment and board service at Mavent, a mortgage compliance software company successfully acquired by Ellie Mae. His entrepreneurial foundation in technology, co-founding Mission Electronics and founding Extend Micro Products, provides him with operational scaling experience and supply chain management expertise that proves invaluable in streamlining construction processes and managing vendor relationships in the ADU market, which is primarily what we're going to talk about today. And then we're also joined by Xander Rappaport, who is the Director of Design and Marketing at Butterfly, where he brings a unique perspective shaped by his background in residential construction and the photography industry. Prior to joining Butterfly, he designed custom homes and interiors with Cascade Development Company, an experience that continues to shape his focus on holistic design and high-quality living experiences. He also provides creative services to clients throughout New York City and holds a degree from Parsons School of Design. So help me welcome Mark and Xander. Thank you so much, gentlemen, for being here. I am going to stop my share. And as I mentioned, everybody, as they're going, please don't hesitate to type your questions into the chat. We will absolutely give time at the end. But without further ado, gentlemen, thank you so much for being here. Looking forward to this.
Thank you for having us.
Yeah, Brett, thank you so much. And thank you all for joining. I really appreciate your participation. Thank you, Leah, for setting this up. And we are excited today to share with you an incredibly new opportunity in the housing space. And it's really it really become a hybrid asset class, kind of a hybrid between multifamily and single family. And we'll get into that. But first, I want to share briefly just my experience with Sense Financial, because I think it really pertains to everything we're talking about here. And I think I'd just like to tell you, gosh, it must have been 11, 12 years ago when I met Dimitri, I was doing some notes purchasing, and then I had started construction. And I was very impressed with Dimitri. He's extremely focused guy that and I actually went to a few of his presentations in person. And my father at the time was in his late 70s, and he had just gone through a bloodbath cycle, and over six figures of his portfolio was wiped out, and he was in his late 70s. And we sat down with Dad and just showed him that he may be out of money in 7 years, and it's horrifying because we certainly wanted him to live longer, and it was just losing money was not part of his plan. But he was just mismanaged, kind of a middle market money manager, all a poor allocation in equities, not being attended to properly. And so I worked with Dimitri and got all Dad's money out of the stock market and put him into a real risk adjusted portfolio for his age, and because he was, I think, 77 or 78 at the time. And municipal bonds, tax-free bonds, and I got him a couple of really nice real estate REIT opportunities that were, and the balanced portfolio was coming in very high, almost 10%. And we all know the rule of 72. And this was fantastic because then Dad could live off of that income plus his Social Security plus his pension. And all of a sudden he had a balanced budget and he lived the life he wanted to live. And fortunately he lived longer than 7 years, and it worked out great. And he basically ate in a little bit to his fund toward the end because he needed more care, but he never had a worry in the world, not from that day onwards. And fast forward almost, I don't know, in 9 years later, I had another very dear friend who, she had a similar situation. She was younger and, probably close to 60 at the time, and very hardworking, typical small business, family-owned business, not that small, but small, the fabric of American economy, not Microsoft. And so, it was just a outsourced equities management thing, terribly unattended to, very poor allocation. And she, same thing, watched six figures wipe out from her lifelong hard-earned retirement fund. And she was in a bit of a panic, and the stress was affecting her health. And I mean, she's a dear friend of mine. And I'm like, let's call Dimitri. And because I had just such a positive experience with him, and I'd referred a few people since then, but hadn't really thought too much about it. I was really impressed that Mina was still there and all the same people were there. And to me, that's stability. And so this friend of mine I'm guessing it's around 3 years ago. She's just every year she's been on able to get a 10% fixed return, rolling it over, extremely low risk, secured, by real estate, and just relieved to know that every year her money is just growing and growing and growing. And in a few more years, it'll have doubled. And she's just, she can focus on her life. She can focus on her kids. She can focus on her job, and she doesn't have stress. And to me, that was really what bonded us to Sense Financial. And I really believe that, that as Brett said, that we ought to have the ability to control our retirement funding and choose asset categories, to varying degrees of risk, depending on your age and depending on your wealth and depending on how you want to allocate it. But at the end of the day, I think the bottom line is a lot of us know more about how to manage our money better than a lot of these self-interested firms do. So I really appreciate the opportunity to talk with you about an emerging asset class that is real and here to stay. It's principally because of the legislation, anyway, that's been enacted since 2018. There's a series of legislation, 70 plus laws have gone into effect, and more every year. So who knows, it'll hit 100 soon enough, to facilitate more affordable housing, more availability, and to increase and essentially to relax. And the last thing I want to say before Xander gets started with talking about the ADUs is, we both have a background in custom home building. So just to kind of tell you where we fit in the spectrum, we are, I'd say, high attention to detail custom home builders. There's always somebody building a more expensive home in Beverly Hills, but we've lived in that kind of 3 to 5 to now 10, $11 million range where we've built and are building homes of that caliber. And to do so requires a tremendous attention to detail and thoughtfulness about things that are often overlooked by people that just focus on the build cost and the economics alone. And so it's a subtle but very kind of sublime part of our strategy. And so I wanted to give you that background, that we're very seasoned, experienced real estate developers. I myself have had a long, long career in real estate, starting with a fire rebuild when I was 16 years old in Venice. When during the summer, the first thing I did in real estate was demo a burned down home. It left an impression on me. And we are doing work in the Altadena and Palisades, and have a lot of thoughts about that, born from personal experience. So today should be really exciting. Our goal is to share with you a lot of information that you may or may not know, and also at the end to really share with you our specific recent projects and share some actual numbers so you could see what kind of velocity and returns you might anticipate if you were to invest in the space. And then we'll obviously answer any questions that you have at the end. So thank you very much for your participation and attendance today. And we hope this is really educational and informative.
Yeah. So thank you, Sense, for having us. I just a little roadmap. The ADU opportunity maximizing returns in today's housing market. The goal today, as Mark said, is really to educate everyone and kind of lay out sort of a map of what we see going on in the space and what is possible, what you can do to a real estate portfolio, what you can do with investment opportunities, what you can do in general with ADUs. So I'm going to give a little bit of a kind of crash course in what ADUs are. There's a lot of information that we could go into, so I'm going to keep it pretty brief. And then we're going to jump into some of the frameworks we use, and then to kind of evaluate projects, how we think about it. And then from there, we'll show you guys some projects. So jump in with questions, and we'll definitely spend some time at the end answering those and going in more detail where you guys are interested in hearing more. But let me get this set up. Okay, nice. So the modern era of ADUs, like Mark said, 2016, we really see a shift where California decides that in order to address this really massive housing crisis that I think we see on the nation as a whole, but was really serious and is still very serious in California, the state decided to basically mandate certain rules around ADUs that local jurisdictions had to comply with, and to basically set a lot of minimum standards that everyone had to follow to make it easier for property owners, homeowners, really anyone with real estate to have fewer restrictions to add density on their parcel, and less red tape, meaning a much easier and streamlined permitting process that was much less confusing and sort of cut out the specific space where ADUs were exempted from certain requirements. And since 2016, there's just been a continual flow of legislation designed to kind of respond to the different ways that certain cities have kind of tried to block what the state's doing, and they've just continued to double down and kind of publish guidelines and laws that make it very clear that this is a priority for the state of California, and that this is one of the key ways that they see us adding housing stock and really alleviating this crisis across the board, from affordable housing to more luxury housing as well, as we'll kind of talk about. And I know that we're going to be talking a lot about California. We're based in Southern California. We work across what I would say the Western United States, and we love working in new places. But California is really important for this because I think across the nation, people have followed the lead of what California is doing. We're just watching more and more legislation, whether it's state mandated or cities across the country, places like Colorado. We're seeing it in certain cities in Arizona, more and more following the lead of what California is doing. So it's not to say that there's not ADU opportunities in other places, but it's just kind of a market in an area that we're very familiar with. So we'll sort of speak from that experience, but don't let that feel like a limitation to where your mind might go. Anatomy of an ADU, very basic stuff. An ADU is an accessory dwelling unit. This is an attached or detached residential unit. We need complete independent living facilities. That means you need a bathroom, you need a kitchen that someone could use, and we really need an independent entry, separate from the main house, right? So this is an accessory unit to a primary dwelling unit. And you can build these with a proposed primary unit or an existing unit as well. A lot of people have this idea that an ADU is a tiny home, or that all ADUs are, 300 square feet, or, studios with, all this crazy modular stuff in there, and you have to, sleep on the desk and all this stuff. But it's really not the case. ADUs are, they really span up to what I would call a starter home size. We have, this is a pre-designed plan that we work with a lot. And this is a 3-bed, 2-bathroom. It's really spacious. All's to say that there's not, we'll go into some of the maximum sizes, but this idea that ADUs are one thing is kind of a theme I want to touch on throughout this, because it speaks to what we do. We do a lot of custom work with ADUs, meaning that we have pre-designed plans, and then we work with them to kind of make sure they fit on different lots. But there's this kind of pervasive mindset that I find, that there's a desire to know, like, what an ADU is, and is it just a modular 500 square foot thing? No, it's quite complex, the different ways that you can use ADUs. Some key concepts, we'll move through this really quickly, but setbacks, land use, height limits. Setbacks are the distance from the building envelope to the property line. So these are kind of some of the areas where the state has set these minimum requirements that cities have to follow. So 4 feet from the side and the rear of the property, an ADU can be up to 4 feet from the property line, right? So that's typically an area where in the past it would have been hard to add density on a property. 20 feet from the front setback, but honestly, I was trying to kind of put in a footnote about the front setbacks, and all of the ways that can be exempted, and it would take up the whole page. But that's kind of a general rule, but there are a lot of ways that we can get around front setback requirements. But generally, I mean, there's certain things we could talk about, but generally that's a pretty feasible requirement to meet. And then there are a lot of exemptions for setbacks where there's no setback, and that's when we're doing a same footprint replacement. Height limits, generally we're looking like 16 to 18 feet on the height limit. It's slightly different when you're attaching to a 2-story existing building, and that brings it up to 25 feet, or the actual height of the dwelling unit. Typically we're kind of trying to, the state wants ADUs to stay in the same character of the existing house that's there. And then there are a lot of other exemptions, parking exemptions. There's a lot of like if you're half-mile walking distance to public transit, if it's a conversion ADU or an ADU that's within the existing footprint, there's no parking requirement. Studios where there's, not a bedroom, those don't require parking. And then tandem parking is allowed as a way to meet certain parking requirements. But generally, we found it's pretty straightforward to kind of get around this, or, propose simple solutions to make sure that people can park on the property when we're adding density. And then really important, no impact fees under 750 square feet. This takes away a lot of kind of that upfront expense of going through permitting and impact fees for the smaller units. And there's no open space requirements, which is, a kind of requirement that there's a certain amount of the property that is, doesn't have building structure on it. So I'm going to just keep moving through this and just talk a little bit about, there's 3 types of ADUs that I think are really pertinent to our discussion today. And then there's a 4th one that could be of interest, but in general, from the investment side, we don't work with it a lot, but we'll go through it anyway. So detached ADUs, this is pretty straightforward, separated from the existing or proposed building. These are 1,200 square feet maximum, and minimum distance requirements from the structure. Typically we're trying to stay 10 feet, but there can be city by city kind of specific rules that you need to follow. And a lot of times we find that fire code is kind of the main area where we want to make sure that we're staying far enough away from an existing structure, because a lot of times if you're too close, there's going to be a lot of fireproofing that's required for good reason, and that can add a lot of costs. But that kind of changes by jurisdiction. Attached ADUs, this is basically an addition to your existing property. And with this, we can go up to 50% of the existing primary unit's floor area. And the caveat with that is that you have to be allowed to put at least 850 square feet, or even more if you have more than one bedroom. But that's just to say that, these don't have to be detached away from the existing structure. You can actually just tack right on to your existing structure and add a separate entry and everything we talked about from the bathroom and the kitchen. And now you've got an ADU, and it's going to completely blend into the existing structure on the property. And then conversion ADUs. I think everyone's kind of heard about garage conversions. These are really powerful tools for converting space that's already kind of sitting there. I like to think of it as kind of the first place to go with any project. Is there any space here that could be converted into an ADU and not require as much construction work and kind of slot straight into what we already have here. And with those, there's no setback requirements. In California, we see a lot of these detached garages that are right at the property line. In that instance, you have no problem converting that to an ADU. It does not have to move and comply with those setback requirements. And there's no maximum size for conversion ADUs, which, it's kind of when you start thinking about that typically you're running across a lot of constraints. So I think typically we're seeing our conversion ADUs in the 400 to 800 square foot range. And then JADUs, which I just want to touch on briefly because it is relevant and it can be a little confusing. But a JADU typically requires owner occupancy on the property, and it can share access to the main house. So when we're thinking about investment opportunities that revolve around kind of having tenants and rental opportunities, unless you're living on the property, this isn't so relevant to the conversation. But it's still an important way that you could add another unit, and I thought for that reason it's worth touching on. And with JADUs, you also have different requirements for the kitchen. You only need a kitchenette, and you don't actually have to have a bathroom that can be shared with the main house. But that's also to say that it does not have to share access with the main house, and it does need to have a detached entrance, and it doesn't have to only have a kitchenette or have no bathroom. It can have all of those things. It just has to be under 500 square feet. So, that can be an area where we can add a little bit of extra density. And that's where I'm going to transition to now, is kind of what we can do at the various, in California, at the kind of in the single family space on single family residential lots. And then also multifamily. And on single family lots, we can put up to 4 units on a single parcel without any change in zoning. We can have our detached ADU, we can convert, we can add a JADU, and we can have the primary unit. And this JADU situation kind of, that's dependent, but typically between 3 and 4. And a lot of times we can do things in the zoning to allow for even more than this, but this is typically kind of the limitations of where we're at right now. And then just to touch on multifamily, because it's just, to note that this legislation really applies across the spectrum of real estate. But there's a lot that you can do on a multifamily lot, where you can convert 25% of the existing unit count in a building. So if you had, a building with 8 units, you can add 2 additional to that building, and you can do that across the whole property. And then you also get a flat. You're allowed to add up to 8 detached units as long as you have. You can't add more detached units than existing units on the parcel. And then what's really powerful is you can combine these. So you can use these two rules together, and we've seen some very interesting projects that are using this to add a lot of housing multifamily properties, and we're doing some projects ourselves utilizing these rules. And I'm going to pass it over, but that's a lot of information. So how do we put this all together? Mark, you want to jump in?
Yeah. So, first of all, just, for those of you that are familiar with real estate development, the bane of my existence as a real estate developer has always been centered around two things: parking and open space. I cannot stress how frustrating it has been to try to even do reasonable density projects and just to be shut down by the particularly parking. And it's just parking is, and so the legislation has opened really alleviated that entire issue in a meaningful way. We have a crisis of affordability and availability, and the latest California Department of Finance shows that about 125,000 new homes were built and added to the supply in California last year, which isn't even a drop in the bucket of the anticipated 2 million units that were short to meet kind of the demand. And of that, only 20% were ADUs. Although the ADUs have grown year over year in a nice way, it's still very early in the game. So I want to stress that. And then the majority of those 25,000 ADUs that were added were just used for people to expand their living space, kind of what I call the post-COVID realization that it's nicer to live and work from home and have more space. And in no way are we kind of knocking that, but from a legislative perspective, the intent of the legislation was to free up housing, and it just hasn't happened. And then with CEQA and all the problems doing non-infill developments and the extraordinarily high costs in California, it stands to reason that we have a supply shortage, and the weather is what's beautiful here. So anyway, I think that this is early in the game where we have the opportunity, and we personally have a strategy to really solve this problem by developing, really elegant rentable units within these communities. And we think it's the least disruptive way to do this. There are a lot of NIMBY factors historically, but there's also a YIMBY. Yes, in my backyard, there's a lot of people that are kind of recognizing that this is kind of the most subtle and tasteful way to add density versus these kind of large developments that kind of are extremely high density and kind of to satisfy affordability. Also, it's a very dignified way. We found that people are willing to live in a smaller space and sacrifice space if they can still have privacy and still have light and still have landscaping, even if it's a small space, if it's tastefully designed. And that's where we've emphasized quite a bit. Next slide. The goal for us is to, and the broader picture is to not, we're very socially conscientious as a company and as people. So we are aligned with the objective, which is to facilitate more housing, to provide returns to ourselves and our investors who are partnering with us, and also to find a way to actually sell these to people utilizing things like tenants in common. And a lot of the stuff is there's a lot of roadblocks, a lot of banking problems in doing that, and cities are still not super open to embracing these things, although the law is clear. So we see this as a 10-year strategy, just so similar to kind of the Sense Financial mindset of thinking in decades terms. We're just getting started, I guess I should say. But with that though, because it's a new category and we feel like we've really learned a lot. So let's keep going. Next slide, please. I'm going to just go over this. Yeah, we're running a little short on time, so let's just go through this. Yeah, let's skip over this too. And anybody that wants to see this, you can see this. And if you want to ask questions about these things, we can discuss that. But suffice it to
Well,
say,
let me
we have a
just,
very clear
yeah,
process for evaluating our markets and evaluating the sites and evaluating. I mean,
and
we
I
have a
think
history
it's
of doing
helpful.
this.
Yeah, it's helpful for everyone, just for context here, that we to take all of that and to just say that really what is important, because you really can do so much with ADUs, is to kind of have a framework for thinking about what you're really trying to accomplish. And just to lay this out before we jump into some of our case studies and some projects we've done, because this will be applied there. I think it's very important to start with what your market is, whether that's where you're already thinking about doing a deal or a project, or where you live, or thinking about who is kind of the end user of what it is that you're building, right? Like, is that a tenant? Is that a buyer? And what's kind of the viability in that market? Like, what are rents looking like? Do they not have a strong rental market? Is there a strong sale market? These types of questions should really lead in across the board here, where we're starting on the market side, then we're thinking about how that's going to inform what we're looking for in a site, because that's super important to kind of creatively thinking about ADUs, from a zoning side. Like, what kind of zoning are we looking for? What's the development feasibility? What is is it a good city to be working in? Is this a city that's made it clear that they like having ADUs built in that city, or is it a city that is really against ADUs and will do anything they can to kind of slow down the process? And then that should all kind of lead into your project plan and your execution and implementation plan, because construction is and architecture and building is very complicated, and it's all about the unknowns. So
Yeah.
there's you want to bring all of that together, and kind of from there we should look at
Well,
some of our
just
projects.
to add one point on that, I will say that I started off over a decade ago, actually probably 20 years ago, doing spec developments, and really started getting very serious about this 10, 12 years ago. And I basically just focused on a local market where I grew up in Costa Mesa, California, and I learned quite a lot. But it's always with my own money, and I basically was just mine to lose. And fortunately, I always made some money, and then I started bringing in people to make sure that as we grew, bringing in checkbook investors to as lenders, and shared the profits with them, and that worked well. And now at Butterfly, we have a team. We have a whole team, and there's a real acquisition process that we go through, a lot of discipline, and a lot of it's based on liars figure, but figures don't lie. So we pay very close attention. We start with the cap rate in a particular market, because we're now building in North County, San Diego, Orange County, Los Angeles, Wyoming, and looking at meaningful projects in Arizona and potentially Northern California, Napa, Lake Arrowhead. We're growing nicely, and we're seeing a lot of really good opportunities. One now in Colorado that we're super excited about because of some similar legislation in there. But with that said, we start with the cap rate. We look at the likely rents. We'll get to the square foot premium for our units versus the standard multifamily later. But we look at the rents, anticipated rents, and then we make our acquisition plus rehab numbers equal a very positive number that meets our kind of general internal rate of return guidelines. And if it meets that market, then it's a good asset to buy. And if it doesn't, if it's a negative number, we don't do it. So there's a lot more formality in place now. So a lot of what I did on my own in the beginning was, and what I've always done is, rather than go out and use somebody else's money, I'll use my own to kind of, learn the hard way. And then once I've figured it out, then we go out to the broader market when we're not taking risks, because we've, actually done this, and we're in the process or have completed 32 different units. So we've got a real pool of data now to be able to support what we're doing. And it's our intention to continue to pursue growth opportunities through finding real estate investor partners that want to help us, accelerate. So we're going to talk. Did you want me to talk about this, Andrew? This particular unit?
Yeah.
So this is a classic, and it's important for y'all to know that this is kind of something that could be done 100,000 times in California. And I say that I think it would require about $16 billion, but there's absolutely no reason, if you look at the size of the state and the extent of the housing stock with lots that would qualify, that doesn't even scratch the surface of the potential market. So this is a huge market. And so what we've done here is we've done what we are repeatedly doing now is we buy a house and found a great local bridge lender, Fidelity, wonderful, great local bank, Fidelity Bancorp, and they had vision when a lot of people didn't want to finance ADU projects. They really could see where this was going, and I appreciate them very much for that. So I've kind of adjusted the purchase price to be reflective of kind of what it would cost now. In reality, we bought it at lower, and we had more carrying costs, but that's kind of the adjusted purchase price when you factor all the learning curve. But what we did was that gray unit we turned into that was the main house, and then we attached that little small unit, which is only 274 square feet, which sounds very small, and it is. We did a very nice job with Thermador appliances, but at the end of the day, we did that, and then that allowed us, by creating a duplex, to add 2 detached ADUs. We converted the garage on the front, which was already there, from a garage into a unit, and then the back is a really beautiful guest home. And the gross rents are $11,500 on this property, and it used to just be an old. Literally, this house when we bought it was fire damaged, and it was a shell. So all 4 of those units are effectively brand new construction, beautifully built. And this is the number, and you can see like approximately, let's say $1.1 million with closing costs, renovation costs around $800,000, and then that's what we sold it for. And the timeline was 13 months, start to finish, and the IRR was in excess of 25%, which is for any IRA investor that can turn and burn in 12 to 18 months and get these kinds of returns. It doesn't take a rocket science to figure out how quickly you can double your money. And so let's move on to the next one. But this is kind of a quintessential. As you can see, the detail. These are the photos. It's a really, and we've had over, I guess, a year and a half now where the turnover is very low. People just love it. In fact, there's a unit that the people need to leave 6 months early. They just renewed their lease, but they loved it so much that they told their friend about it before they put it back to the property manager, so that their friend could slip in there and take over their lease at their rate, because they know they're getting a great deal, and it's a brand new house, and you just don't see this kind of a stock available. It's everything is just so crappy. So we really are building these nice things. And I don't know, Xander, if you want to talk about this, or I can. We have developed this. We're really proud of this. We won an award for a project in Costa Mesa, what's it called? Golden Nugget Residential Design Award for innovative housing, because we put 4 ADUs effectively on one parcel, and the entire national architectural community recognized how thoughtful and creative it was, and compared to some unbelievably large organizations and esteemed architects. So we've developed this. This is our butterfly home, and what it is, it's a luxury primary home, a beautiful luxury primary home with one principal ADU and a convertible ADU in the garage. Obviously, that would make the owner subject to having to live in the house or the garage. The JADU could be mom lives in it, because she needs an ADA compliant, really nice place, and then we're living in the main house. It could be a boomerang child. It could be, but to get all 3 in one house, you have to have owner occupancy in the JADU, and then you could actually add a 4th unit as a detached. So again, it looks like a home. It is a home. It's a home with a lot more flexibility, and then these things can be kind of used differently over time. It could be if your family's larger, you could utilize the space, but then as your kids move off and go to college, as mine have, you might say, why don't we move into the downstairs and start traveling more? So this is the future of housing, if I could just say it in one simple sense. This is the future of housing. We need more density, but we need it done very tastefully with a lot of thought and design and care. So,
and across the, I think this is in particular interesting because it's across the spectrum of housing. I mean, it's not just affordable housing where we can add density and really meaningfully impact people's lives, but we're trying to address this in a lot of different places, whether it's in the middle market or here in the luxury context. You know, you can see it's very different than adding a bunch of units. It's all very integrated, as you can see kind of from the conceptual site plan. It's all one structure. And you know, that lends a completely different feeling.
And you never know when you drive by that has any multifamily characteristics. And that's something that's always been extremely important. We did one in Costa Mesa, and all the planners were asking, could they circulate our design? Because we were the first ones in 2019 to ever take this legislation and build a ADU in the front and then attach it with a trellis to the garage, so it looked just like it was a bigger home. And to this day, you drive by on Cabrillo in Costa Mesa, and you would never know that's an ADU. So we're tasteful and thoughtful. This is the one we won the design on. Same thing. I bought it years ago, entitled it. It's a 4-unit project. It's under construction right now. We raised $875,000 of. We structured this one. We do it 2 separate ways. We structured this one as equity with a guaranteed preferred return, and then because it's equity, it's the true return, which our goal is. It's a 10% pref. And we anticipate a high 20s IRR. An 18-month time frame is we're very much on track for that. And it's approximately 1.6 million. We paid 1.7 million, and it's going to sell for mid 4s, based on the anticipated rents and the 4% cap rate. Can you go to the next one? So we get a market rent premium for our assets. And we have, if you're interested, please reach out to us and we can share this with you individually beyond the slides. But we have a lot of data. And what's fascinating to us is that, just to say it real simply, and we use the 2 test markets that we did the most work in. But as you can see, there's a giant premium for this small space. And this is on the same street, like 2 streets over. And we have a great customer that owns a bunch of assets throughout Southern California, one of which is right down the street. And we know exactly what they're getting for rents. And we're getting these, 98%, nearly double the per square foot. And it doesn't cost double. So it's a great investment. And we could talk more about this later. Next slide.
We're coming up against it here.
Yeah, exactly. So we'll just jump to questions. So last slide. So here's the thing, like we have 2 different types of investors, okay, just simply put. And those of you on this call are likely to be one of the 2, okay, or else you probably wouldn't be here. One of them is a more conservative investor that flat out doesn't want to make investments unless it's secured, period. So what we've done is, fortunately, we found a trustee to actually act as a trustee if we need multiple investors in a deal, which is what we did on 16th Street. We had fractional investments of $125,000 that equaled to $875. And one of the investors was my friend who runs a very successful mortgage platform. And he agreed to, because he invested, and he agreed to be the trustee. So he is managing the interest of the second trustee on behalf of 6 or 7, with my math, different investors. So it's fully secured, collateralized by the asset. There's also obligations. And then Butterfly, our team, is in a subordinate position. They paid back at the refinance, at the earliest exit. And these investors are really just looking for velocity. They want to invest, get a really nice IRR, get the money back in, and then redeploy it, and do that again and again and again. The second group is the equity group. And these are people that are typically a little higher net worth, or have more experience with real estate development or real estate work, maybe want to be more passively involved, but still they know the game. And obviously the returns can be even better when you're talking about true equity. And so, we're also, doing some things in the middle, and depends on dollar thresholds, whether it makes sense to be pure debt at a fixed rate or unsecured, or if there's upside for being kind of an equity partner. And so, the key points to take away here is that our typical turn is 12 to 18 months. 3 years, like the maximum. That's completely unnecessary. We're turning these things faster and faster because state law allows, and these can be either sold as rentals or refinanced, and the majority of the money can be paid back. Some investors want their money back and want to just move on to the next deal. Other people want to stay and be part of the long-term ownership. So I hope that gives you a good flavor. We're running a little over on time. We want to give you a chance for questions, but please do reach out to us at unlock@butterflybackyard.com. Unlock@butterflybackyard.com. We'll be happy to answer any questions and go through any scenarios. I hope that you have a lot more questions than answers. Please, let's jump into the Q&A, and we're happy to answer questions as long as time allows.
Yeah, no. If you guys are able to stay over a few minutes, I am too.
We have I have all day, and
Okay, cool. Then let's not skip any. So Andrew's asking, I have 10 acres, 1 ADU, but I think I would need to build out more septic to add. Can I finance this?
Yeah, I mean, financing is a challenge, but I can check with my bank partner and see. I've got a few other lenders that are in the space, but it's tight to get financing for ADUs. We would like to talk to you offline about that large of a parcel with septic and find out more about the location and find out more, because we're finding that there are a lot of very, very significant bonus density things that have just recently happened, and it's really a deep dive, but we are looking at 10, 15, 20 acre parcels right now in 4 or 5 different ones to go at that. So we just, please connect with us directly. Were there any other questions?
Yes. Keep going, Leah. She's going to pop them on the screen. Hold on 1 second. Sorry. There we go. All right. Larry is saying, Anaheim has told me the max height you can go 4 foot. Setback is 10 feet. Is that incorrect? To be clear, the existing house is 20 plus feet.
Yes, that's incorrect.
Yeah, that's incorrect. The rear, for an ADU, the rear setbacks and the side setbacks are 4 feet, subject to easement. So you might have a utility easement or another easement, but yeah, that's not correct. I mean,
well, I think, but you mean the height requirement is 10 feet on the height of the structure, which is absolutely incorrect.
Yeah, it depends on the city, but they vary between 27 and 29 feet for a single story, and ADUs also can go to 2 stories. There are other restrictions, but yeah, you're I think they're confused. They're using the regular, but not the ADU site. We have additional we have more freedom to go closer to the setbacks. And if there's an existing structure that was originally permitted as a legal non-conforming, you could use that. We've done that a number of times, where we have a building that's built 2 feet from the property line, packed up next to a power pole, and we'll be able to go in there and just keep the structure, redo it, and effectively tear it down and redo it, but leave it in place because it was permitted. Do you have any other questions?
Yeah. Somebody named Very, I'm not sure if that's the name or not. Is this for accredited investors, minimums, and how to invest?
It can be for accredited investors if it's for a pure equity investment, but for the debt structure, it's not necessary to be accredited. The minimums vary. I think that generally, we're at like 100,000, and it changes quite a bit at 500,000, and then we've got some people that we're in discussions with that have quite a bit more that they're looking to deploy. That they'll end up being more of the controlling interest of the company that might be formed. But our success has been with kind of we've done deals as low as 50,000. We have a few deals that that are kind of at that 100K range, but we're typically looking for investors that want to get to 500, but you don't necessarily need to. And certainly the accredited issue is very valid. So we would just structure it so that your requirements meet the needs and put you in a deal that and just to be clear, part of we have a limited amount of money ourselves, and we are investors ourselves, and we're all very involved in this. And so tying into and partnering with folks, and I like to use that word very, very loosely, partnering, but aligning with people like yourselves gives us the ability to accelerate our growth and mutually benefit by these opportunities and to continue to increase our capacity as a builder. So Hope that answers your question. And again, please email us unlock@Butterfly Backyard for introduce yourselves, and we'll start a dialogue, and we'll find some way to help you. Okay, thank you. Next question.
Yeah, that same person is asking if they can use qualified or non-qualified. I mean, the short answer is yes. It can be your
Yeah,
personal funds or your retirement funds. Absolutely.
absolutely. Yeah. Or a combination of both. Actually, I
Or a
know a
combination of both.
really smart guy that knows how to do the ABC structure. We can talk about that offline. If you have enough money, yeah, it's yeah. The IRAs are awesome, and yes, you can use either or both.
Yep. And then Larry's asking, what percentage of a junior ADU must be in the existing structure? Not sure I understand that, but
100%.
you guys do. Okay.
100%. Yeah.
I think
It,
actually there are cities that allow you to have part of it. You could actually add space and still have it be a JADU. And then obviously if it's within the structure like a garage, that's a no-brainer. But you can add a JADU adjacent to your home if you wanted to. And I
yeah.
don't know what percentage, and it definitely varies by city, but it's definitely doable as well. We'd be happy to work with you. Again, unlock Butterfly Backyard. It's small. It sounds like this is a particular project, and maybe you're just looking more for guidance and advice, which is great. We're here to support Sense Financial and their clients, and we will help you any way we can if it's nothing more than just advice. Next question.
Yeah. So this is the investment side, 25 to 50K. Is that about right?
Not necessarily. I mean, we should talk to you about it. We're compiling a list in these. We have smaller deals, and in the structure that I've identified with this group that's functioning as a trustee, we could consider that certainly 50. 25 might be below the threshold, but it varies deal by deal. What we typically do with that platform is we'll just look at the total equity required. We'll put in the money first to buy it, and then what we'll do is we'll use our line of credit, and then once it's entitled and once it's owned, and once we have a plan, we'll go out and bring in and backfill the money. So if it's only a 250K project, or it'd be easy to potentially have that 37.5 number and just divide it by whatever eight. I don't know exactly what the number would be, but yes, absolutely. Stay in touch, and we will have you on our list. And when we find something that's a little smaller, we'll be happy to run it your way. But look, it's always good to start with whatever you have. It's a great way to invest. And next question.
Are there any ADU rules that allow you to build a garage for the ADU as it pertains to setback requirements? And I think we're trying to get some clarification on what that question is, but maybe you have an idea.
Well, it first made me think, and we are doing a project right now that involves this, but if there's an existing garage and you don't want to remove that garage, you can build your ADU above the garage. And you can also add a staircase and do all sorts of stuff. So that's like one way of getting around if there is an existing garage and you sort of wanted to replace it and add another garage. I think it's a lot of times more straightforward to just add the ADU. The problem, I believe, and Mark, jump in if you have different ideas, but when you start to say I'm adding a garage, you're no longer adding an ADU. So you're now going through the typical
Very
process with the
much.
city of adding space, and you're not going to get those setback exemptions. So if you're building above a garage that's on the setback or something, that's a really great way. And personally, we think parking's so important. So especially in California. So we
Yeah.
oftentimes suggest that. But
Yeah, that's a great answer. And just please email us because this could be a 20-minute discussion. For us to really help you, we really need to understand your site constraints, and we're happy to do it. We do this a lot for friends and family and potential customers. And anybody that's a friend of Sense Financial, we consider to be a friend of the company. And regardless of whether you work with us, we'll be happy to help you. So, do you have any other questions?
We got some clarification from Larry. That's the last one. ADU to have its own garage, regular setback
yeah,
requirement.
the garage would not. Yeah, in this case, you're kind of talking about building a separate garage, which is kind of the first scenario we said, which is, you wouldn't benefit, the garage wouldn't benefit anything from these ADU rules because it wouldn't meet the requirements of being an ADU.
There you go.
Yeah, and if you put the ADU behind the garage, then it would work. So if you have a driveway and you want to put the ADU on the 4-foot property line, and then you want to have a garage attached to it, and it's truly a garage, then that would work. There's various ways. We're very, very creative. I mean, this is one of the things we spend a lot of time doing. We had some standard questions as well. I thought some of those might be relevant to the group. Could we ask any of those for those that want to stay?
Go for it.
Did you have the list, Leah? Is she still there? I mean, we had.
You know what? No, hold on. Yeah, I got it. Let me see. Um,
So in summary, we have secured investments secured by second trust deeds behind the construction loan and our own personal guaranteed construction loans. And so there's very low risk and, opportunity to, get 10 plus, maybe as high as 20% returns, 15, 20% returns, which is obviously great. If you can turn that every year or so, you could grow your IRA funds quite a lot. And we know folks that have done this and repeatedly, and it's great. We also have more of a true equity strategy, which is, potentially much higher upside, but also, with some degree of risk. So, what are those other questions,
so
Brett?
what is the typical deal structure for your standard 3 to 4 unit ADU investments?
Right. Like I said, we've got two main structures. We always buy the asset ourselves because, we always put our own money in to buy the asset with the down payment and the bank financing. We have all the construction financing lined up. We're a tier one borrower in the space and have a number of deals. The structures, there's two different primary ways. One is just flat out, we figure out a way to have it be a secure investment. If somebody's got 150, 200,000, 250 to invest, we would just do one deal with them. They would have their investment would be fully secured by a second trust deed. Our equity and our role and our ownership would all be subordinated to that lien until that's fully satisfied with whatever the terms. The second is a larger deal that it maybe have more partners that are equity investors that are not lenders. And so, as we all know, being in an equity position with a secured lien gives you tremendous amount of control, and being an equity partner gives you less control and less risk mitigation. So we structure those deals differently on a deal by deal basis, but those are typically a little larger amount of money. Some cases, other cases, it's syndicated down to a smaller number that makes it palatable. And let's say if you had $100,000 to invest, you could participate in those. We would just, bring you into our next deal, like the one we're just finishing on 16th Street. I mean, it's a great deal. So hopefully that answers that question. What was the next one?
Yeah, we actually got one from the audience that I want to address. Mike is asking, do you offer deals that qualify for 1031?
Yeah, but if you're using your IRA, you don't need a 1031. But yeah, we certainly do. Anything qualifies for a 1031 exchange. For example, if you have to exchange into a deal, yes, we have assets, a number of assets that we could help you exchange into. We also have another resource that's got an unlimited opportunity for 1031 exchanges. And then if you use your IRA, then you would need to exchange because you essentially just are not paying tax on it. But yes, I'm very familiar with all those rules, and I have a couple of really good, very large organizations that are our customers now that are very, very, like one in particular has got 40 years history in Orange County. It's a $1 billion fund with over 11,000 apartments in Southern California, and they have a really cool program for exchanging funds into their program if you want to stay as a passive investor and get some really nice returns. It's not our stuff, but again, we're really here to help educate and inform and really whatever it is you need. We're big on goodwill, and if we can help you someday, maybe you'll help us. So please email us, and yes, we'll connect you with them. They're in Irvine, and I don't know where you're located, but they're in Irvine. They're a great company with a fantastic reputation like Sense. Any other questions? Can you fire those other ones off?
Let's finish with this one. What is the typical investment time period, and what is your strategy for exit?
Yeah, so thank you. That's a great question. The typical time frame is around 12 months. It's sometimes sooner, but it's kind of safe to say 12 months to 18 months is the reasonable time frame. And the exits, there's basically two exits. One is we sell it, or two, we refinance it. And typically on the refinance, you'll get a minimum of 60% of your money back. That's what we've seen anyway. I've also seen on their last couple of deals, that we give the opportunity for everybody to take their 60% out, but we also encourage them to stay in the deal and tell them about what it might be worth down the road. And we've seen half of them decide they just want to stay in the deal, and the other half get all their money back. So it works out really nicely. But ultimately, we have our controller has a whole process to kind of, when a deal closes out, we provide updates monthly on our deals, and then when it gets to the closeout period, when we have a refinance and appraisal and stabilization, we'll offer people that want out, and people's life circumstances change, or they get deals they want to get involved in. So it's nice to have that 1 year opportunity to have a choice. And on the other hand, if you like the asset and you like the deal and you like the potential to stay, you can stay. Everyone's got a different investment horizon. So that's kind of the answer to that. There were a few others, weren't there?
Yeah, it looks like a couple more came in. Can you repeat on that trustee? I think he means trust deed, which may allow for folks with smaller investments. That's one question.
Yeah, thank you for asking about that. So we were faced with a challenge where I actually own this personally. We also have a butterfly fund that's principally my family and some of our key management. And so Butterfly didn't own this. I owned it, and I wanted to basically bring in new investors from this platform that I had worked with for over 10 years, and a principal, a local Newport Beach guy who I really like and who I've done a bunch of loans with as a developer over the years. And so he came out to the site and looked at it and said, "Wow, this is awesome." And this was before we broke ground. It still looked like this terrible old house that was there. But I showed him the plans, and he knew what we've done. He just said, "I'm in." So he bought what we set up units. In this case, we wanted to raise $875,000, and we were offering a 10% guaranteed return and an opportunity to through the equity, and we provided all the numbers. It was a short model, but it was short and sweet. And we offered close to, it's going to probably be close to 25 plus, maybe 30% return, depending on how it plays out. So he said, "I'm in," and literally 2 days later, he wired me the money, and then he agreed to be the fiduciary, the trustee. And he's a licensed mortgage lender. He has a huge platform with, 1,200 investors on his platform, and doing notes. Okay, trust deed, exclusively debt on trust deeds, which has its advantages, but doesn't have these kinds of returns. So I came up with the creative idea of having him provide the best of both worlds to his clients. I said, "How about if you actually, as a trustee on behalf of all of your essentially lender investors, but they bought equity, but they were really treated like debtors," which is, you're getting the benefit of both. You get the equity upside, but you get the lending protection. So yes, to answer your question, that's how we got to the lower number. Now that's close to $5 million project. Most of our projects are half of that. So to extrapolate, I'd say that $50,000 to $75,000 is absolutely feasible. But what happened is we would say, okay, we need $500,000. So we would offer 10 increments of $50,000, and all 10 would be treated with the same rights and be under what I would call a blanket lien. That one of the participants would be the actual trustee who's putting his own money in, and he's not at all related to me. He's completely unrelated, and he's in a different class representing you, for lack of a better way of putting it. And it was really great, and he was he's like, "Wow, Mark, you're one creative guy." But I have like close to 30 years experience in mortgage finance. I sat on the board for 7 years of the mortgage compliance company, and my co-board member was ex general counsel Wells Fargo, and some real top-notch people. And I always wondered what I was doing there. But I was an angel investor in the company. I came from a technology background, so I saw this, and I learned a lot of how to structure things in a way that give people the opportunity to have a peace of mind and to sleep at night, and also still get really meaningful returns. So I hope that answers your question. Again, if you want to talk more, that's the email. I'll be happy to share our phone numbers and we can engage afterwards. Were there any other questions? I think we had one or two more.
Yeah, there's a couple more from the same person. He's asking, are there K1s?
Oh, yeah, of course. I mean, in the case of the equity, yes, you definitely would receive a K1. But again, it doesn't sound like if you're asking about a K1, you're not using a checkbook IRA. So I would encourage you to get into the Sense family. It's like such a great way to do this. But yes, you'd get a K1, and you would, and one of the principal, and that's a smart question. Thank you for asking it. One of the principal advantages of getting in and making you an equity holder versus a debtor is that you can take advantage of the capital gains, and also if you have other depreciation or other investments where you could offset your capital gains income, which is quite a bit lower than the ordinary income tax rate in California. So you would get a K1 as an owner, and then you would be able to recognize there's no gain until the sale. There's no gain on the refinance, and so you could decide kind of when you want to exit, when you're comfortable taking your gain, and then you could probably do an exchange into a different asset. Probably subject to the same rules. Like, I'm not an expert to be able to comment on a fractional ownership. I know if you own 100% of something, it's certainly feasible. We could certainly research that for you. We have the good legal counsel to ask that, get a quick answer. But yes, you could do that. But again, I'd probably encourage you to really use their vehicles, because that eliminates the need for all that. You're focusing on yields and just doing deals and getting that yield up, and doubling and tripling and quadrupling your investment, so that over time, you build it into a war chest.
There you go. Last one is any fees?
No, I mean it's the opposite of a loaded mutual fund. No, there's no fees.
There you go.
No, we do all the heavy lifting. This is a passive investment. There's no requirement of participation other than you will be repeatedly provided with updates on the status of the project, and you'll have very solid documentation as part of the. If you elect to go down the equity path, you would have membership and a very kind of well vetted. Some of our people are very experienced, and some of them are attorneys that invested. So the documentation on the equity side, when you actually own part of the property. On the debt side, it's the same situation. You would have very adequate protection, and we cover all those fees. There's no fees.
There you go. One of the beauty of self-directing is that there are no fixed fees, right? We have our flat annual fee of $250 to maintain the plan, but that's it. When you make $100 on an investment, $100 goes into your back into your plan. There's no load fees. There's no ongoing fees associated with the investment. So just another.
Yeah, and whatever that nominal fee for the easy 5,500 form, if you're over is it 250,000 or $500,000? I mean, you have to report every year, but there's really nothing more to it than that.
Yeah,
it's such an efficient way, to build wealth.
Absolutely, yeah, and no fees for 5,500. So
yeah, great. I mean, we're setting these up for our kids, because our kids now are kind of and just getting out of college and establishing their own financial independence, and we're going to pay to set these up, because we have 4 kids, and most of them actually will qualify for one or the other of these products, and we think it's a great way to teach them how to build their own wealth and to grow. I mean, Xander's the oldest of the 4, so he's got the most experience, intuition, and knowledge about business, and has already got himself his own Roth IRA. And I've told him about connecting with you guys as well. It's just, I really feel like what Sense offers is great. Did we have any other questions? I think we had one final one in that prefab.
No, that's it.
Well, thank you all very much.
Thank you so much. Yeah.
Yeah.
Ahead. I'll give you guys the last word. Go ahead.
Well, thank you, Brett, and thank you, Sense. I mean, just reach out if you guys have more questions. We always love to help people and teach people and look at your projects. It's always interesting. Mark, any last words?
No, thank you very much to everybody. This is great, and thank you all for participating. I'm
Thank
sure
you,
none
Leah.
of you've dropped off, and yeah, thank you, Leah. I know a couple of the people that I invited to come had to go at 11, but this will be recorded, right? So we'll be able to receive a recording of this presentation, so we could forward this to some people that maybe couldn't make it. And spread the word, and reach out to us if you have any questions. We're happy to help. Thank you very much.
All right. Thank you, everybody. Appreciate it.
Yeah, you guys have a great day.
All right. Take care. Bye-bye.